$25 million, that's the ticket size that we have talked about this week regarding the funding from Norfund and Ethos to Balaji Group, and we're delighted to have the East Africa Regional Director for Norfund, William. Karibu sana.
Asante sana.
Glad to have you this morning.
Thank you.
William, let's start from here. I looked at the deal and noticed something very interesting for me, is that Balaji being an EPZ-based firm, of course their proceeds are in USD. To what extent was consideration of FX risk, especially in the present environment where we've had a bit of tightness in that space, a consideration for this transaction?
So that's a very good question. FX considerations is always part of our evaluation in investing in this part of the world. And fortunately for this transaction, being a dollar-denominated company, and our investment being dollar-denominated investment, it was an easier match, right? We didn't have to worry about how the dollar is going to behave because they earn dollars, we're investing in dollars, they'll pay us in dollars. It was kind of a perfect match from that perspective. And I think given that we've been working on this transaction for a while now, we're seeing the tightening of the dollars, but I think for us, given that we take a long-term view, we expect the market kind of to stabilize at some point.
All right. And I'd be curious, still on that note, to what extent has the present environment, where we're experiencing a lot of hard currency tightness, prompted you to recalibrate your risk appetite looking at frontier markets such as Kenya?
So I would be lying if I said there is no impact, because risk is part of our business. You know, we actually invest because there's risk.
And return.
And return. But as an investor, Norfund is quite a long-term investor. So we take quite a long-term view. We know that the market will always have shocks and volatilities. But from our point of view, as long as the fundamentals of the business or of the sector or the country remain solid, we tend to look at the bigger picture. So tightening of the dollars, yes, is an issue. I think if we were doing a local currency facility today, we'll have to have very difficult conversations at the investing committee. But on a dollar kind of transaction,
it's a smooth sail.
It's easier. We are looking at other risk factors than dollars.
Okay.
Yeah, than FX.
So there's 12.5 million USD from Norfund to another 12.5 million USD from Ethos. I'm curious here, who courted the other towards this transaction? And I'm asking that because typically I'd imagine, being a DFI, someone would come to you for the de-risking element.
So that's what I think is the obvious thing. But on the other side, as DFI, actually part of our role is to mobilize. So we often are a minority investor. We often not the largest or single largest investor, and therefore we tend to come with others. So in this particular transaction, it's actually us who courted, as you put it, our partners, Ethos, and they were quite responsive. I think we found ourselves in a situation where the funding need is a bit larger than what we can do ourselves, and we looked around and figured these guys are quite responsive, they move fast, and we've worked with them in other places, and I think we felt quite comfortable that they will be a good partner for us in this particular transaction. Because it's a mezzanine fund, this is really the expertise. So they bring a lot to the table to primarily an equity investor like Norfund.
I see. And speaking about the structuring of the deal, I was looking at the mezzanine debt factor. And I'm curious, is there an option for an equity conversion down the road, or how did you arrive at this being the optimal funding structure?
So the history of this transaction, initially it was an equity transaction, which at some point didn't work out because of actually COVID issues, made it the equity side didn't look quite attractive because COVID just made the environment very, unsustainable. Yeah. And then we morphed it into a mezzanine structure. And, we usually, in mezzanine, we usually use conversion options to enhance return. Sure. But the way we've structured this transaction, we actually have an upside potential even without conversion. And we figured, given the nature of the business, family owned, very well run, these guys are passionate about what they do. We don't see the need to drag them to a sale, right? And therefore, our optimal structure was do a mezzanine, participate on the upside, and get repaid. So our exit is, will be repaid when the facility matures at the return that we've agreed with the promoters today.
So when you talk about the exit route being you repaid, do you see it potentially being bank refinancing, or how do you see that panning out?
So there are two options. Of course, we do a lot of modeling when we evaluate investments. So our financial models indicate to us that this business is a growth business. Our investment is going to step it up to another level, quite frankly. And we see a very robust cash flow generation during the course of our investment. And therefore, from an internally generated cash flow perspective, the business has healthy cash flows to retire our facility. Alternatively, and you always want to have the fallback in case things don't pan out the way you think, we actually believe that at the point of our exit, there will be, a myriad of local banks looking at taking us out or refinancing this facility. And in any case, we are doing capex. Banks are good at doing working capital, and I think at that point, the relationship they have with local banks, in my opinion, will be strong enough for the banks to be comfortable to take us out when our facility matures.
Okay. Speaking about the architecture of the deal, what's the horizon of this debt facility? And also, when you look at the 12.5, is that your typical ticket size? Because by market standards, I thought it looks a little large.
Yeah, actually, it's sweet spot for us. So our minimum ticket is 5 million, but I can tell you my colleagues are happier to wake up to do 10 to 20. So that's really where we land. And in terms of horizon, as I said before, we take a long-term view. Textile is a long-term business. We're doing capex in this case. It's expansion. So as you can imagine, these are things that require time. And for that reason, we are on a 9-year horizon in this particular transaction. That's not typical, but I think because of the nature of the business, the comfort we have with the promoters and the company, we feel that is a kind of runway that the company needs with our funding to optimize their performance.
Okay. So if your typical appetite ranges between 10 and 20 USD, I'm wondering, for a $25 million ticket size, why did you stop at 12.5? Why didn't you bite more than that?
Because we had a partner to share with, You don't want to eat more than your partners do. Yeah, so that's really why we decided to do half-half.
I see. Fantastic. Let's switch gears a bit. So the textile industry is one of those which is flagged globally for pollution and not being ESG conscious. And I'm curious, when it comes to this investment matrix, to what extent did the impact ESG consideration now come into play?
So from our perspective, Norfund, primarily, we actually do not just invest for money. We have to have a role to play, which is mostly around ESG, governance, best practice systems, this kind of stuff. And in this particular case, I think textile has been flagged as, ESG non-compliant, polluting, all the bad stuff that you can think about. But when you dig in and try to understand how the sector or the ecosystem really works, the buyers are very serious about ESG matters. In any case, we realize that, the producer actually graded grade A, B, C, and it is actually based on how good you are when it comes to matters ESG. So as we got into the sector to understand it better, we realized that yes, there are challenges, but there are also a lot that is happening, which are good. And from an investor's perspective, we think that the way to make a difference is not to stay away. Yeah. It's to actually get in, work with the companies, tackle the challenge, and move them to a better place. Yeah. And so ESG is a huge consideration when we get into companies. And in this case, I can tell you it was a big conversation. Okay. But we feel confident that the partner we've chosen, first, is doing a lot of things right. And secondly, is committed to improvements. So we have a whole improvement plan that we put together with them. It's actually part of the transaction agreements with timelines of what needs to be done when. And they are committed to getting those things done. And we are actually supporting them to get those things done. So I think I take our pride when you have this conversation around ESG, because we are one of those investors that actually take pride in working with companies to improve. We don't go into companies because they are the best. We go into companies because they can be the best.
Okay, fantastic. And still on that note, one of the pet questions asked in this sort of conversation is, do you often find that you need, when you're talking about now the impact ESG compliance, do you often find that you need to do a trade-off between your returns and being green?
Not at all. This is a question I love, because there is the misconception that you cannot do good and make money, that it's almost impossible to be green and be profitable. Yeah. I completely disagree. And I'll use this as an example. We're investing in a washing facility at Balaji that, because of the investment alone, without doing a lot of capex, is going to enable them to double their capacity. And how does it do that? Right now, they have a bottleneck in the washing facility. So they work, and then the clothes take time to be washed. With this investment, they can actually wash everything that they produce. What that means is they don't have to wait for the washing to get done before they produce again. And if you look at the economics, it's the same facility, same people, right? Same machinery, but double production because of this one investment. But what is great about it is the facility uses 70% less water than what they're using now. Wow. That's huge. The facility uses 60% less chemicals. I mean, this is money, right? So this is money saved, right? Less chemicals in the washing facilities than the. And this company has the largest installation of solar power, rooftop solar, 1.8 megawatts. What that has done for them is a 30% savings on energy cost.
So the financing you're extending towards Balaji Group, is there any augmentation from your technical assistance facility for the wider value chain?
Yes. So as an institution, as I mentioned before, we invest with an expectation to make an impact. And that impact is company specific, but it can also be sector specific. And we actually have business support. So we have a pot of money that we put into our investee companies. It's a match, so it's, let's say the cost of the improvement is $100,000. They put 50, we put 50. We invest in whatever needs to be done. And in this particular case, I'm a strong believer that we need to bring supply chains locally. And this company strongly believes so. And they are supporting other SMEs that feed into the supply chain. So people who produce buttons, collars, all these kind of things. Why import if you can get people to produce it here? So part of this work that we're doing is to help them identify those kind of supply chain providers, strengthen them. In fact, they plan to bring some of them into their premises, give them space, and commit to buy from them. Yeah. So basically saying, yes, my need is X. you come sit next to me, produce X, I'll buy it from you. So the externalities are actually, I mean, the multiplier effect is actually larger than the direct jobs that this company is going to produce or to create as a result of our investment.
Okay. And how is Norfund protecting its investment in portfolio companies which were significantly adversely affected by the multiplicity of shocks from COVID-19 to Russia-Ukraine?
So Norfund, you know, and I'm not saying this because I work for Norfund, but I'm saying this because this is really what Norfund is about. We are a responsible investor. We are there when things get tough. And during the COVID period, during the shocks that came as a result of the Ukraine situation, we actually sit around the table with our investees, figure out, you know, what is there a cash, and most of them actually is a cash crunch. You can't sell enough, you can't send the goods abroad, or the market here is melting, and therefore you have issues with working capital or, you know, just normal running cost. And there are cases where we've actually gone back to our investment committee and said, company X needs to pay salaries, right, next week, and there's no money in the bank. And if they don't, they won't have workers the following week. What do we do, right? So for us, it's cushioning, right, so that we give these companies runway, and we've actually given companies runway to get through the trough until things turn around. And we've done that to companies that we have in tourism. We have done that to companies that we have in floriculture. We've done that to some companies we have in, you know, in FMCG manufacturing. And sometimes it takes just, I've seen what we've done in some cases is actually just saying, okay, you're supposed to pay us your X, you know, $1 million in the next quarter. Don't pay. Use it for your internal operations. Then you'll pay us in the next cycle. So those kind of things, I think we're a listening investor. We are practical and pragmatic, and often, you know, we've not gone into companies and said, you're going to shut the door. You know, no, that's not the kind of thing.
We want our return back.
No. I think the return can be delayed, but if it's delayed and we finally get it and everyone gets out of the situation, everyone is happy.
All right. Final question. How is your pipeline looking like? I understand you are deploying further in the coming week.
Yeah, so, you know, we just signed another investment for $14 million in another clothing company called Hela Clothing. It's a debt instrument. That will also to help them bring supply chain locally within the region. And of course, these two transactions that we just signed now, we've been working on them over the past year or so. So the pipeline going forward is robust, but not as robust as we would like it to be. In the sense that it's true, the global situation, the macro environment is affecting companies. And we are an expansion investor. We invest for expansion. And when the environment is so uncertain, a lot of expansion projects tend to be either scaled down or just put on ice for the time being. So that's affecting us. We're seeing, you know, entrepreneurs who are very eager to work with us saying, you know, William, I know we've had this conversation, but let's watch how things are going to play out. But on the other hand, we're also seeing an opportunity that we didn't expect to play out the way it's playing out, because some of the supply chains, or a lot of supply chains, are actually quite global. So there are people who are producing or finishing products here, but all their raw materials and intermediate products are imported. And over the since COVID and with the Ukraine war, we've actually realized that you have capacity, but you don't have raw material because supply chain is cut, right? So people are finding solutions locally, and we just closed a transaction in Ethiopia in December. This is an FMCG manufacturer. They produce edible oil, and they were importing all the crude into Ethiopia. But when the situation, COVID happened, and then the war in Ukraine, they couldn't bring, crude, so they didn't have product. So what they decided to do was to invest in a solvent extraction plant locally, because there are a lot of oil seeds in Ethiopia that can be converted to edible oil. So you see, this is someone who was very comfortable in importing crude, but when the global shocks happen, they then started thinking, are there solutions that we can find locally? And this investment opportunity came up. They're like, we need to invest in a solvent extraction plant. There's a lot of oil seeds that our farmers have here that sometimes they don't know where to take to. Yeah. We can buy them from the farmers, so creating actually a local supply chain that did not exist. So we're seeing some of those coming up, and we're very happy to invest in those opportunities because it helps to strengthen our economies by creating jobs and along the supply chains, but also just making us more resilient. Yeah, that we don't have to use edible oil to pay dowry because it has become so expensive.
Yeah.
Yeah.
Okay. So $12.5 million has gone to a textile company. Another $14 million is going to a clothing company. You're really doubling down on this sector.
Yes.
Are the margins that attractive?
And I mean, of course, if we're not going to make money, we wouldn't do it. But I think it's beyond the margins. Yeah. It's about creating jobs at scale. And for us as an investor, we invest to improve lives. And I can tell you the best way, and I'm a testament of it, to improve lives is actually to create sustainable jobs. Yeah. And I think there's no better sector than textile and apparel to create jobs at scale. Yeah. Right, in our ecosystem, right? And I think as we continue to have these larger companies, and this is really what we're doing to become larger and larger, the backward supply chains start to happen. Yeah. I don't know whether you're as old as me, but when I was young, we had cotton growing in some of in this country. We had the Rivertex of this world, the Kikomis of this world, that were industries that were buying local cotton and converting it to garments. That industry died because, those, converters or value adders stopped to exist. Now, when you bring a value adders here, strengthen them, naturally, those, people will start producing cotton, creating more jobs along those value chains. We have ginneries, working. So it's a whole chain that can only develop when you have a strong off-taker or a strong buyers, as it were. So, and that's why for us we are really, you're not going to start producing cotton if there's no off-taker. Yeah. But if there's an off-taker who is buying it from somewhere, and they're like, we need to buy this thing from here, then there's reason for people to invest in the backward parts of the value chain.
Okay. My final question, and I know we've had a lot of conversation about debt financing, but flipping it now to the equity side, given the conversation you've had about the multiplicity of shocks, have you seen a significant change in the pricing in this market?
So equity is a very tricky instrument, especially in our markets, for two reasons. One is valuations, and two is exits. So entrepreneurs work really hard, and they build fantastic companies. And so they get very emotionally attached to them. But equity conversations can be very demeaning to them sometimes, in the sense that the value that we bring to the table, you're like, do you even know what you're talking about? But I always tell people that as an equity investor, I make money at entry. If I buy high, I have to sell high to make money. But I don't know whether I'm going to sell high. So I have to buy low to kind of not guarantee, but increase my chances of actually making money out of this investment. So valuation is always a big problem. So I think if you don't see a lot of equity transactions, it's not because people don't want, it's just because there's always a big gap between price expectation and what is the ask and the bid. Yeah. Now the exits is another big problem, that our capital markets are very shallow. We don't have many strategics that are buying equity positions. And therefore, if you're not a long-term player like us, it becomes very difficult. Actually, 70% of our portfolio is equity. Yeah. Only 30% is debt. Yeah. So we have a lot of equity positions. But I can tell you, it takes time to build. It takes time, patience to exit, and
a lot of hand-holding.
A lot of hand-holding. And right now, what the approach we are taking is we're also using debt to get into equity positions, because it's like a marriage. You need to date, get to know each other, figure out whether this long-term is going to work out or not. It's easier to do that through debt when you're already in than, courting for ages, right? So our debt positions are also, in some circumstances, helping us as a bridge into that equity conversation.
I see. Now, this has to be my final question. I promise you there will be no other after this. Every conversation I have with players like yourselves, whether it's buy side or sell side, my question always is, what will it take for you guys to exit via the NSE? I mean, I sat down with Ascent's David Owino and he told me, look, there's no guarantee if I took my 60% to the market, it will be taken up entirely. What's your response to that? What will it take?
And I started with this, that we have very shallow capital markets. Yes. And I think, as a seller, I want to optimize my value. And I want to guarantee that if I do an issuance, it's going to be taken at the right price, which is not always guaranteed in our market because of the nature of what it is. That's one. But secondly is also just the illiquidity in the market. I'm working in some transactions where the stock is listed, but it's actually a drag on the company. It's not adding value. Yeah. So I think, what will it take? The market just has to grow and be robust. I think, I honestly, let me put it this way. Our local investors have to have enough interest in the market, and buy and sell, not speculate, because I think we have a lot of speculators who get discouraged when the price falls and they just forget.
They bolt out from the market.
Right? And they buy things when they're going up. And
wrong time.
Wrong time, everything wrong, right? And the thing, for me, that's the biggest problem. And so if you're an investor holding significant stakes in companies, taking them to the market, especially our market, is, at this moment, is not the best thing to do. I think it will take, I would say we actually don't need, do you have 4 stock exchanges in East Africa?
Yeah.
We don't need 4 stock exchanges in Africa, let's be honest. We need 1 stock exchange at most in East Africa, but one that is robust, right? That all these companies, across the region are trading in 1 stock exchange. Yeah. There's enough money to go around. But if we have all these small, even entrepreneurs don't have confidence in taking their companies public, because, it's actually going to be a drag on you. You have all these regulatory or compliance expectations. The analysts are calling you for whatever, but the market is not rewarding you for the hard work you're doing. So what's the point?